Hi, good afternoon, everyone. Welcome back to the channel. I'm joined today by a special guest, Garrett of NEOS Funds. Garrett, welcome.
Thanks for having me on today. Appreciate the opportunity.
Absolutely. So this is the first time we've had anyone from NEOS on, and the audience is really excited about getting out of less stable, higher yield dividends. I'll just say that, and looking for more stable alternatives, particularly that can maintain the NAV and still pay a decent yield. So I've noticed a lot of your NEOS funds are able to do that. Can you explain to the audience how you're able to do that?
Sure. So our process, we've been doing this almost 20 years now between myself and my co-founding partner, managing option-based strategies for institutions. We also pioneered bringing option-based ETFs out well over a decade ago. But with the NEOS products here, we always try to take an institutional approach to looking at not only what income you can generate within the options market, but also what the contribution of that underlying reference asset is. So S&P 500, NASDAQ 100, even fixed income or Bitcoin, different types of asset classes we offer. And for us, really the focus is what is a quantitative rules-based approach that we can take by looking at all of the data sets available to us across those underlying reference assets, the options market, and saying this is a consistent yield that we can generate off of the options. But here is the ability for us to manage through the model to also have capital appreciation in the underlying share price. And so we're looking to always not generate a yield that is going to ultimately truncate the full total return of the investment. And so I think that's like a core difference. And the way we're really doing that is how our model readjusts the portfolio on a monthly basis, taking into those factors I was just mentioning, what's going on in, say, the S&P 500, what's the volatility level, and what is the VIX doing within the S&P, and what is the options market really telling us? And that is taking a very systematic institutional approach to gauging what you can consistently deliver on the income component, but also focusing on the total return opportunity.
Awesome. Now, okay, one of the audience members wants you to discuss a new fund that's coming out with leverage.
Sure. So we do have a boosted series that's going to be coming out soon. That is going to give you a little bit more exposure, a little bit more risk on than our standard covered calls, saying like the SPYI, QQQI, and BTCI. The idea behind that is when you're in a covered call strategy, you're selling away some of that upside in order to generate the current income. Well, if you're able to take a reasonable, systematic approach to adding some leverage, so some boosted is what it's really meant to be, is you're hoping to seek to give you back kind of that return of the S&P 500 that you're able to give up because you're taking more risk in the portfolio. The reason we're really bringing that out is if you look at our product lineup today, it's all about being a solutions provider to investors, meeting investors where they are today, where they need to be in the future. And so on our equity suite, we have a hedged equity income products that are going to yield in that 6 to 9% range, but is really hedging from days like today, where the market's selling off greater than 2%. We have our core products, essentially, which is what we're talking about, SPYI, QQQI, and that's going to give you kind of a core cover call approach where it's slightly lower volatility, but the majority of the risk of the equity markets. And now the boosted would be the more risk on kind of strategy. So it's allowing investors to really toggle between three risk and income exposures of more like kind of very bullish, more the aggressive, if you're thinking about it from kind of asset allocation, moderate, and then more conservative.
Okay. And what would your target yields be on the more aggressive ones?
We can't talk about that today until the funds actually get live and they're out there in the market and we've had a distribution, but would be happy to come back on and certainly be able to talk about that.
Sure. How soon? I know it's like what, 75 days from like the filing or so. Like how soon do you think we might see this one?
Yep. So the one delay that has happened is just the government shutdown. Wasn't specific to us. So that just held up the review process. So we're hoping in the next kind of 2 months that those products are out. We take a very much more of like an institutional approach to this. So we want to make sure the SEC's had the chance to review it, given all their comments, they're comfortable with it. So once we've gained regulatory approval, we also want to make sure all of our vendors and service providers are fully staffed up in a good spot as well. We want to make sure the A teams are always there, everyone's available, and we agree on a launch. We do have competitors that just launch a plethora of products and just throw them out really quickly.
Right.
In our view, you got to make sure that everything from an institutional standpoint and all approvals have been met. So for us, hopefully from today, we're probably another 1 to 2 months at most, out from those products launching.
Okay. So the SEC review probably was stalled by the government shutdown.
That was, unfortunately.
Yeah. But that's good that you do the due diligence. I think the market's being flooded with ETFs from so many companies. And like I say, what I see a lot with my audience, what's happening with, not to name drop other firms, but what's happening is that, we're getting great dividends, but when you factor in the NAV erosion, we're ending up getting CD rates when you factor in total return. So I think we're all looking for, like I say, more stable NAV, even for a lower dividend. Total return is what my audience is really focused on.
Yeah, I mean, and that's really what NEOS has always stood for, is we've managed these types of products and strategies for the largest pensions, endowments, foundations, family offices around the world. And as we think about things, right, you got to look at what your total return is, and you got to look at what the expectation of the underlying asset class is able to do. Sure, you could sell an at-the-money call option on 100% of your portfolio, and generate on the S&P, call it 2% a month if the VIX is kind of around 20. But right, that's not going to give you the price appreciation and long-term kind of durability. And so something we always put forth is, one, of course, investor first. We're huge investors of our own products, so are our families. But we're really focused on being a fiduciary and a steward of, capital for others. And so whatever puts the shareholder in the best possible situation for their investment is what we're always seeking to do on a daily basis. And then in addition to that is what is going to continue on a long-term institutional trend. As you look at owning products for decades and years, not just short term, how are you going to make sure that that investor is getting a wholesome return on a net after tax basis, but relative to what that underlying asset class is producing? And so I think those two things are really like the key drivers of how we design our products, to make sure that we're sitting there always thinking about the investor, the risk tolerance, what fits within a product, and ultimately what that net after tax return is going to be, and thinking about stability for the long haul.
Okay. Yeah, that sounds good. Now, one of the sentences you said there, did you mention that you all hold your own funds personally?
Yes.
That's awesome.
Yes, we're all investors in all of our products here. That's the whole concept of the joke of, right, being a chef but eat your cooking too.
Exactly.
Is we're really building products that, listen, we listen to the market, we hear what people say about their portfolios. That's where we gauge a lot of our idea generation for products and different things. But we've also managed these types of strategies for ourselves, family members, and everyone for so long that we view and look at ways to enhance the overall asset allocation. And if we're going to bring something to market, not only should it make sense for other investors, but it should be making sense for us as well, and be able to put money into every single one of our own products.
Yeah, definitely makes sense. That's great to hear. Do you have any like single ticker ETFs in the works?
We don't. That's not something that we focus on. So we think about a little bit more broad categories, indexes, sectors, industries, more as like a longer term institutional approach to, thinking about how you can build asset allocation. So at the end of the day, we're not bringing out what would be just a single name, ETF with exposure to, say, NVIDIA, or IBM or Exxon or anything. We're really going to be focused more on those sectors, energy, then, the major indexes of the S&P, the NASDAQ, et cetera. And like I said, we're trying to be more mindful and thoughtful of like optionality for investors to espouse their market views. But at the same sense, like we want to focus on where those kind of deep institutional, allocations can be, to where we feel really good about the taxation of index options and the liquidity within those spaces. So that's a big factor as we think about just overall risk and, investment opportunities.
Right. What are your thoughts on zero date to expiration options?
You can look at them as a couple of different ways, but overall, like where we think about option-based strategies is really not so much of how to overlay an option on just a 1-day exposure, you're getting a very synthetic equity exposure with that because it's such short duration. But if you want to be able to try to generate income and lower your volatility, because we're focusing on income strategies, not so much just like growth and appreciation, or leverage factor, which is obviously another component of what options can deliver for people. We're trying to really focus more on how do we lower that volatility, generate income, and provide a good solid total return instead of just kind of giving what would be more an expensive synthetic equity exposure by just selling such a short dated, call option or something in those types of portfolios that you're not yielding really as much as you could if there was some time value in there.
Right. Now, you mentioned NVIDIA. So NVIDIA's earnings today, it looked like they were going to be a huge jolt for the market, and I don't know if I've ever actually seen this as an investor, but the market did a huge U-turn today after basically overall good news. So what are your thoughts on like the overall state of the market going into the end of the year?
Yeah, so I think what's unique about today is actually nobody's heard any major news, right? There hasn't been one major catalyst that flipped the market for being up 200 basis points to, down 200 basis points. I mean, 4% is a pretty strong reversal that you've seen in the market. But overall, I mean, listen, I think it comes down to the Fed. It comes down to interest rates, right? The projected interest rate cut for December now is down to like 30% of an odd. So I think as you think about the real key drivers in the market today are where are interest rates going to be? Where's the health of the economy? There's been some more concerns lately, just around credit and what's going on with, defaults and stuff, not so much just on some smaller companies, but also just as like a more broader theme right now that's going on. So I think at the end of the day, we haven't seen anything major, obviously, from economic news with the government being shut down. Jobs numbers, getting reported from kind of that September timeframe, albeit very delayed, was actually more of a positive that the economy was kind of hanging in there because the jobs market's going to be really important to watch. And so I think what we've been talking about a lot for this year and heading into next year is volatility, like we're seeing today, is going to happen. It's going to continue to happen. And we feel that you should build a durable portfolio that's going to withstand your risk tolerance. And so like, as we talk about that is can't always just jump into maybe what is like the most highest returning, investment or the highest flashiest yield. You got to look at your own risk profile and say like, this is what I'm trying to achieve out of my portfolio. This is where I want to get to on a multi-year term. How do I get there? And then as you're assessing your portfolio, make sure that if you do see markets down like this 2, 5, 10, 15%, and you're okay to weather that, then maybe that's an appropriate risk tolerance for yourself. But if not, then think about rebalancing and diversifying your portfolio. And that's a lot of what we do here. I mean, we have products from international equities to fixed income. The fixed income ranges from 1 to 3 month treasury yields and CSHI to TLTI, which is a 20-year plus bond. We have risk managed high yield strategies. We of course have real estate, we have gold. So the idea is those big core building blocks of your portfolio to give some more diversification, overall. And so I think that's more as we're thinking about where the market's going to head. There's a lot of tailwinds, there's a lot of headwinds, but ultimately we do see the fact that more spouts of volatility can happen. You get these shorter term shocks with a little bit more elevated vol. And with that, leverage these types of like NEOS products to take advantage of volatility and convert it into a positive for your portfolio.
Mm-hmm. Certainly. Yeah, this earnings season, companies like SMCI. I mean, I don't know how much you follow individual tickers as close, but it makes sense missing earnings, but just the sell off from there, it's like what fundamentally, like you said, the Fed getting the jobs number. My thought was that it makes it less likely that we're going to get a rate cut because Powell's going to see it as, we don't need aggressive rate cutting now because the jobs market is okay. Whereas maybe a bad jobs number would lead to a rate cut.
Yeah, listen, aggressive rate cuts is not a positive for the market, right? I mean, that's stressing that there's an economic slowdown going on. There's an issue within jobs, right? And consumer discretionary spending and all sorts of things. So like to see a very methodical and still pretty strong economy, and having a slower rate cut is actually a net positive, right? As we all look at like instantaneous headlines and how to trade short term, moves in the market, I think as we think structural, right, longer term benefits for people to compound wealth, right, and build more passive income, seeing a more slower, methodical rate cut because the economy is still doing somewhat well, right, is actually a very healthy thing to see. And so we'd rather see that than aggressive rate cuts, because that's going to, really stress more of, an economic slowdown.
Right. But is your outlook overall, like over the next year or so, you think the economy will still keep growing, or do you
I
see a
do.
recession?
Yeah, no, I mean, listen, I think we can see, I'm much more bullish on the market overall.
Yeah.
I think we get through this. I mean, next year we're also going to have, right, Powell's out and somebody's going to be in. And that person that's going to be in is certainly going to be picked by someone that wants very much accommodative easing, and wants to support, right, a very strong economic, growth and backdrop. So definitely more positive on the market. I don't see anything that's really shocking me at the moment that is structurally, changed to where everyone should be running for the hills. So I think next year can still be a positive year, although, be prepared for spats of volatility and make sure you can weather those types of, investments within your portfolio. And I do love to talk about this, like just this term of durability, right? Just make sure whatever that means for you, however you need to build a durable portfolio, don't have all your eggs in one basket. Think about different ways, to ultimately diversify your portfolio. And that's obviously a big part of what we do here is we look at, major indices across your entire asset allocation of equities, fixed income, and alternatives to kind of do that.
Yeah, no, I think the index funds are much better than certainly single ticker risk for sure. I know we've kind of touched on this before, but do you like additional leverage on top of the indexes as well?
So listen, the short answer is yes, but I think it's in moderation, right? As you think about leverage, it's a double-edged sword. It can be very positive when things are going well, and it can, of course, detract from your portfolio when things aren't going well. So I think, again, it comes back to it's a great tool within the toolbox to construct your portfolio allocation, but doing it in moderation or having the ability to shift into it and out of it. That's really what we love as we think about, I guess, pun intended, the optionality, right, of products that we bring into the market. Is we have something where you can take less risk than the market. You could be at the market, or soon you could be greater than the market. And it's really allowing individuals to espouse their views on what they're trying to achieve in their portfolio. Everyone's portfolio is unique. Everyone's situations are unique. And so I think that's like what we try to espouse for, is meeting investors where they are, right? It's not where your friend is, your family is, somebody else your age could be, right? It's very much where you are. And so I think there's an absolute great opportunity to have leverage, right, in the right institutional structure within your portfolio, but also know what it does and it doesn't do so that you can manage through that with the other allocations that you would have.
Certainly. Let's see. NEOS seems to have the best NAV stability combined with highest yield of all ETFs organizations. Agreed. Yeah, we mentioned that already. Now, I normally ask this in the beginning, but I guess I'll ask this more towards the end. But I guess tell the audience about, like your background in the industry and what inspired you all to create NEOS.
Sure. So Troy and I met almost 20 years ago on the institutional sell side. We were covering hedge funds, some of the largest mutual fund complexes, and we were at a firm where the two of us really dedicated a lot of our time to building out their options desk, bringing on research providers, traders, and really educating a lot of the major hedge funds around different ways to trade options in their portfolios. And so what we saw was really the ability to add significant value and benefit in option-based strategies, but saw that that wasn't able to be cascaded or provided to regular investors. And so in 2012, we started our very first asset manager that by 2013 launched what was the first option-based income ETF in the market here in the US. And that was always as a means to allow investors to gain access to more institutionalized strategies that they couldn't already do. And then we thought about how do you do that on the most tax efficient manner? And we saw the major structural benefit of including these types of investments within your asset allocation. It's not a full replacement, right? Like when you think about your portfolio, you're not just buying one equity fund for everything. You're not buying one fixed income fund for everything. Like, you're not going to buy one options fund for everything, but there's a great opportunity to really support that asset allocation. And so we had left there, started our first asset manager, merged in with a bigger company for global distribution. Ultimately, that went well, but we knew that there was more that we could do within the ETF structure and wanted to evolve that and innovate it. And that's why we brought out NEOS. But our management team has been together well over a decade. We have over 32 professionals across the organization here that all range between, on the investment side, north of 25 years experience across trading and investments. All the other departments are averaging over 10 to 15 years. And so it's really been a culmination of just a great team, great organization, and the ability to always focus on the investor first, but coming more from that institutional background from hedge funds, pensions, endowments, and managing these types of strategies for them, but the ability to bring it to all investors.
Awesome. And I heard you say how pensions and institutions are using your funds too. I think that's a huge plus as well, possibly compared to some of the competitors.
Yeah, and these institutions, right, do trade some of this themselves, right? And so you have a lot of pensions that manage to write an obligation, right? I think generally a 7% kind of obligation that they meet to fund the pension liabilities, right? Those people in retirement. And so you tend to see a lot of is selling kind of put spreads on equities, like equity indices against your fixed income, and cover calls against your equities. It kind of evens out that volatility and more consistent straight stream of returns that the pension needs. And so that's the kind of a lot of the similar ways we look at our product set is, to meet what those big institutions have been able to do now for everyone to build within their portfolio.
Mm-hmm. Awesome. So question, could you have an entire or most of the portfolio with QQQI and SPYI since it offers some growth and income? The person says, my plan is to eventually live off the dividends.
So again, it really comes back to that investor's risk tolerance. Would I probably suggest just those two ETFs for their entire portfolio? I can't say it because I can't give obviously their financial advice there, but most likely not. Right. The idea is that if you thought the S&P 500 and the Nasdaq 100 were your entire portfolio, and then you're looking to generate income off of it, yes, those are, in my opinion, of course, the two greatest products that are going to focus on lowering the volatility a bit and generating, tax efficient income to live off of. But at the end of the day, it's really about having that, diversification across your portfolio. And so I would always suggest that not in any one's fund, not any one issuer, think about the diversification across a portfolio. Because at the end of the day, if anyone tells you you should own all of one issuer's fund, especially their own fund, right, you should be wary of that.
Yes.
I think every investor should think about their risk tolerance and what it is they need to, and still build sustainability and diversification.
Yeah, certainly. This commenter says, Garrett is great. Give him a big thanks from the community. Keep doing what they are doing. We need stable fund strategies like those from NEOS.
Well, thank you very much. I appreciate that.
So on that note, well, thanks for coming on. And we'll hopefully the market rallies, and we'll look forward to having you on when those other funds go public.
Sounds good. Well, thanks for the opportunity. Appreciate everyone who joined and listened in today, and anyone who's part of our investors or our partners, and we really appreciate it.
Awesome. Thank you. And for the audience, check out NEOS Funds and like, comment, and subscribe, and join Discord, and we'll see you all in the next one. Take care. Bye.